So, Basel III. It's one of the biggest regulatory changes the banking industry's been through in decades. How do you see those changes impacting the relationship between banks and corporates? And how do you think businesses should adapt?
Well, I think the Basel III regulations are coming down the line like a freight train at the moment, and there's a lot of changes that both the banks are going to have to incorporate. If we take one element of Basel III, for example, the requirements on intraday liquidity reporting, then we're going to see some of the requirements that the banks have to comply with inevitably trickle down to the corporate sector, because the banks are going to have to report on a new set of data or a new set of data requirements that they haven't been reporting on previously and haven't had access to the data for. So they'll be able to identify predictable patterns of behaviour. They'll be able to forecast patterns of behaviour in terms of currency flows. And those data sets inevitably will be made available to corporate treasurers of corporate entities. So they could make good use of that type of information to identify good payers, bad payers, predictable patterns, etc., and manage their own balance sheet more effectively. So I think that's the good piece. On the downside, depending on which side of the fence you sit on, then the banks are going to be able to identify exactly who is using and who are the consumers of that intraday liquidity. And I would say that an inevitable step is that they're going to start to charge for that. So corporates might find that where they are heavy consumers of intraday liquidity from their bank provider, they may start incurring a charge for that.
Just to add on to top of what James has said there, we're going to have what the Treasury Alliance calls the end of notional pooling. So notional pooling is a key tool of treasurers today, whereby they can have multiple branches, multiple jurisdictions, multiple banks within those jurisdictions, and pool balances together. So you could have one entity which is cash rich and one entity which isn't cash rich. As long as they have a bilateral agreement between them, they can net the position and not carry an overdraft where they don't have the cash. However, with Basel III, the insistence now from regulators is that this is not necessarily the correct way to conduct banking, because you're not truly reflecting the capital position of a corporate entity at any given point. You're almost hiding or shadowing the position from another area. So IAS 32, or the investment accounting standards, which have been revised under the 32nd version, necessitate that these kind of pools be exposed and advised on. So what does this mean for corporates? At the end of the day, a lot of the corporates today within Europe would be notional pooling, more so than the US, because in the US, the concept of an overdraft doesn't exist for many corporates. Right. And small to medium-sized enterprises, they would have to get a credit line to have that facility, whereas in the Europe, we allow an overdraft to occur and we charge an interest for it. Now, this whole concept of notional pooling has allowed for treasurers to carry on without having to sufficiently fund their entities. What this will mean is that now they'll need to have very hands-on visibility of cash positions across various entities. And tools like BankSense would allow for them to quite easily and quite quickly be alerted to positions where they do have a short position so they can fund it. Because the future is banks themselves aren't going to offer notional pooling. So speaking to a number of large banks, as I have done in the past, their end strategy is to get rid of notional pooling just because of the regulatory requirements which stand behind it. And as James correctly said, there's a larger scrutiny now on the bank's positions during the day, the intraday liquidity positions. Now, if they're allowing this kind of bilateral agreement to be placed between branches, is that truly reflective of A, the client's position, and then B, the bank's position? Because the bank would inevitably have to net off against another one of their entities. Yes. So it's a challenging time, and I think thankfully, humanity always finds a way of finding a solution, and we have, and fintechs are finding solutions for this, and BankSense is a list of one of those products which would certainly help a treasurer find alternatives to notional pooling.
So having access to real-time information becomes much more important.
Yes, absolutely. And conducting trend analysis and being aware, forecasting, these are key things which are going to become a huge part in the way treasurers conduct themselves.
If you take notional pooling within a provider out of the equation, then you have to have greater visibility on where your cash is. And it has to be a bank agnostic solution, because if you take away notional pooling, actually what you're probably going to end up with is that corporate treasury is going to have to bring in a process of physical pooling. So you're going to have to manually move these funds between providers. And so you need a solution, you need technology to sit between the corporate and the bank and aggregate that information and allow the corporate treasurer to make decisions, to move the funds physically in the market. But in order to do that, in order to make timely decisions, you need real-time information.